please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. So you got 65, 66 odd points on the Nifty. 10,671 is where we stand at this point in time. No real change, smooth sailing, and this is the third day that the market is coming up the way it is actually, I should say. We've got Kenneth Andrade, who's joining in right now. Needs no introduction. Founder and CEO of Old Bridge Capital Management. He runs a PMS. He runs the AIF. A large pool of money of HNI investors. Kenneth, it's great to have you with us here. Thanks very much. Appreciate it. This year so far has been pretty tough, you'd say, for most people. I mean, a dose of reality really injected into markets and everyone, for that matter.
Well, it depends upon how you look at it, because ever since the last 2 years, you've always been chasing stock, right? So this is the first time where you can actually sit back, take your time, build a portfolio, and establish confidence or track your portfolios or the companies that you've invested in the past. So I think it's an easier period at this point in time for portfolio managers, and not so difficult as it has been in the last 2 years.
But this big blow up that we've seen in mid caps, small caps, Kenneth, what do you attribute that to? And do you think that is now largely at a very general level behind us? So
the trade that's effectively playing out right now is essentially on earnings yields, okay, and as bond yields continue to move higher, which has been the case globally, there's been a pressure on earnings yields, and that's the volatility that's been set in place since December of last year. So my sense is until there is very clear direction on how this how bond yields actually build up, I think markets will continue to remain volatile. So from the context of where we are right now, I think bond markets offer you as good an opportunity as equity is probably for this year and probably for the next year. And I think we should be fairly happy that both asset classes will play out, have the opportunity to play out secularly over a year or 2 year periods. The only caveat out here is you might just be ready for a slightly lower return on the asset classes, but none the same. I'm not too concerned about where the markets trade right now.
What about the macro risk? Because now we have Brent, which is back at $75, but there's no guarantee that it couldn't go to 85 from here on either. And then we have the yields hardening, you mentioned that, but we had the rupee depreciating. We're better than other currencies nonetheless. But in your sense, how real is this macro risk? Is it as bad as, say, what we saw in 2013?
So a significant part of that is already played through. And we've got a trade that's played through. So let's put it this: the last 4 years has been a great macro for the environment, and the micros were weak because corporate profitability wasn't kicking in. I think that you have a reversal right now. So you've got the macros which are iffy, okay, and the micros are quite nice. So earnings have bounced back, and the cash flow in the system is basically extremely high currently. So when it comes to equity investing, I don't see there's too much of risk as far as mortality risk that existed in the past. You probably have valuation risk, but if growth comes back, then valuations will also not be so much of a problem. I mean, you had that correcting from last year to this year, so markets remaining where you are. 1 year forward earnings is down almost double digit. Forward P is down almost double digit, but markets haven't reacted so sharply.
And just coming back to the kind of pain that we've seen in the mid caps, a lot of people have been stuck in positions and lost money in this correction that we've seen recently. What would you recommend to them in terms of their portfolio? Would you stay on? Would you probably, take your losses and reinvest somewhere else? Or do you expect the pain to probably, recede when it comes to the mid caps from here on?
And before you answer that question, one label which has stuck with Kenneth is mid cap king, right? For the last 10, 15 years.
So more of a reason.
Go on.
So we've seen a situation like this. The question that we need to ask is whether we'll see a period like 2013 all over again. And that was a time where you were getting a large part of the small cap and the mid cap companies virtually free of cost. But there the stress on the balance sheet was enormous. Okay, today that doesn't exist. So I guess it's a case-to-case, you have to go case by case on your portfolio to see whether it needs a reshuffle or whether you're happy being there. Like I said at the beginning of it all, it's a nice environment after the last 2 years of chasing stock to be in an environment like this where you get significantly more opportunities than you've had before.
Okay, fair enough. What are the risks? I mean, I want to highlight two things. One is this is a political year. You got state elections next year. You got the general elections. As an investor, how are you thinking about those things?
I think the volatility will continue to exist. Okay, and at the same time, you basically have to realign yourself to lower valuations than you've historically seen. And if you align yourself with these two parameters, I think corporate India is doing a phenomenally good job in terms of migrating their profitability further. The moot point of all of this is, despite all these events that are happening, balance sheets continue to further deleverage themselves or consolidate themselves. So there is no new capacity, greenfield capacity. I think if you speak to any manufacturing business or any services business, the incremental amount of capacity coming on stream is significantly slower than what the demand for that industry is.
So while people rue that fact that there is no capacity, people look at the CMI data and say, well, there is no investment happening, etc., etc. You're flipping that around and saying, well, that actually might not be all that bad news for existing businesses.
Yeah, it's the best thing that can ever happen, because first you have to optimize your historical capacity that you've set up. So if you go back to 2007 and 2006, 7 and 2008 and look at capacity utilizations or asset turnovers as a number out there, they were close to 90%. Okay, today that number is down to 75%. So you've got surplus capacity on ground. And what happens if capacity utilization increases with no incremental capex going on the ground? Effectively, your return ratios shoot through the roof. Okay, I think the next 2 or 3 years, if you quantitatively put those numbers together, you will see that scenario emerge. So you will see earnings going up, and you will see cash flows increasing, and you will have no addition to your denominator, which is your capital employed. That's the best thing that an equity investor could ever want.
But underlying demand has to pick up, right, for all of this to play out, which is no capacity, efficiencies pick up, ROEs improve, cash flows improve, at some point pricing comes back, but all of that is based on the fact that demand continues to improve.
So demand is a function.
Does it have to significantly improve, or this rate will do?
Demand is a function of GDP growth. So if GDP is growing by 6%, I think the correlation to any industry at the worst case is 0.8.
Okay, well, we do have the GDP numbers coming out this Thursday. But Kenneth, wanted your thoughts on this entire consumption theme which is playing out and which everybody is very enthusiastic about, from the Voltases of the world to the HULs of the world. Your thoughts on that particular space and where you see it go probably in FY 19-20?
I mean, we're a large country, so so everything that you have, this country has got potential to sell a lot of products down that line. But you also need to go back to, it's coming off a reasonably soft 2017. Okay, and that number is fairly robust right now. And if I go forward into the next 2 or 3 years, given the government socialist agenda which is there, and it's not going to go away even if there's a change at the center, I think per capita incomes are going to trend higher. And if they trend higher, there is a significant amount of demand that could come into a number of these verticals that could exist.
Okay, you know, what we'll do is we'll put up Kenneth's portfolio. I mean, the portfolio at Old Bridge divided by sectors, and where is how much of the AUM is allocated to which particular sectors, and we'll do it systematically. We'll go sector by sector and ask Kenneth to give us the logic and what are the things that he's actually betting on. So top of the list, and this has been true for some time, has been agriculture and allied sectors, right? I mean, actually everything agriculture. That is 30% of your portfolio. And it has been that way for a while. We're talking about tractor companies, pump companies, agri-input, seed companies, everything. How is that playing out for you, and what do you see going ahead there?
So we haven't been, we're not such an old portfolio. We're just about a year and a half or so in terms of putting a portfolio together. So things won't change that rapidly with us. I think we're fairly optimistic on non-urban demand. Okay, and non-urban demand, the largest industry out there is basically the agricultural and related businesses. And that's why we see significant amount of opportunities that exist. So if we're talking about the social spend of the government and increase of the government's balance sheet, significant part of that number is going to go into this part of the world. And if you do the basic economics of the industry in terms of the total agricultural GDP, I mean, it's a negligible part of that entire share. So your crop GDP is about 15 to 16 lakh crores. Your total inputs, the mechanization, including tractors, etc., the entire industry size is about a little over 200,000 crores. Okay, so it's a negligible part of our entire sector, and if that number has to expand significantly as mechanization takes place and the technology moves in, we think this business is not fairly represented as far as markets are concerned. Okay, so it goes with a commercial sense that yields have to come up, output has to grow, and mechanization has to take place, and that's all going to contribute to why we see the biggest industry in non-urban India could do well, and this trend could survive for a fairly long period of time.
I mean, some of your holdings in that space include Kaveri. There is Jain Irrigation, I think there is Shakti Pump. Some of these have been talked about and discussed. But that's just one area, which is agri and allied. We have a couple of more to go. Kenneth, stay with us. We'll take a very quick break here. I have to do that. Come back and continue this conversation.
We have Kenneth Andrade still with us of Bridge Capital to continue talking about all of the sectors that he has holdings in and all of the sectors that he doesn't also. So Kenneth, in the break we were talking about how you don't have any exposure towards pharma, IT, or even financial services. Why is that, and are you changing your mind?
So, as an investment, I mean, our investment premise has always been that we need to be ahead of the curve or early entrance into any cyclical turn event that takes place. And most of these companies or most of the businesses in these companies are fairly large and mature businesses, and there's no huge valuation arbitrage that we can find. So, for instance, we've always found financials to be very pricey at one end, and some of them at the other end are completely insolvent. So the choice is difficult, but if we can do a trade outside that entire environment, we're happy to do it. So our business is not to buy industries. We're basically out there to buy the best capital efficient
business.
Yeah, at fair valuations. And some of these companies don't really fit that norm. So we're happy to stay out of them.
That applies for pharma and IT as well.
Well, IT to an extent, and IT is more of a stock-specific trade, and our sense is that pharma will go that way. I mean, it will become more stock-specific than rather as an industry or as an industry. Financials is by the way, also a very stock-specific trade that's taking place. You got a handful of companies doing well, and you got a bunch of them not doing well, right? So the same thing will hold true for pharmaceuticals as and when the business environment stabilizes for them. A few companies will come back, not all of them will.
About 12% of your AUM is in power generation and the exchange space. I think you own JSW Energy. It is a significant, meaningful portion. I think over 3-4% or so of your AUM. Just talk about that space. What do you see there?
I think that goes in line with the broader context of it all. We found a distressed industry where we probably have 2 or 3 companies making profits. So if you take out the state utilities, there are not too many companies making profitability. So we probably at the bottom end of the entire pricing cycle as far as the end product is concerned. Sure, there will be always a question mark around an asset or two on the ground, but as long as the pricing of the end commodity is hit rock bottom and stabilizing, and
which is power.
Yes, power.
Right, but and not at rock bottom anymore. I mean, you found them.
Pricing and as in the electricity prices.
Correct.
Yes. Yeah,
correct.
they were. I mean, overnight rates had gone down to almost.
Yeah, had.
Yeah.
Right.
But that's a 1-2 month phenomena that's changed it.
Right.
Okay, but it won't change the metrics of the company so soon.
Right.
You have a significant amount of latent capacity which is still there. The industry operates somewhere closer to 70% capacity utilization. So there's enough of capacity on the ground, plus you have standard assets. But from a valuation perspective, you will get a lot of power generators very close to book. Okay.
The only one you own is JSW Energy, power generator.
We've got a couple. So,
Okay.
so we got two generation businesses.
And on the exchange side?
There is just one business.
Right.
So if so on one end we are playing capacity utilization or utilization of assets as they step up. On the other side, we're taking a bet that volumes will increase on the exchange, on the trading platform. So it's a volume versus price equation that we've put together in the portfolio.
Okay, I see 10% going into cable broadband, and I'm obviously thinking that it's not telecom.
No, it's not telecom.
So what is the rationale there?
Again, an industry which is not getting external capital to fund growth and competitive intensity.
So is it the Hathaways of the world? Are we talking about that?
Yes.
Okay, so what kind, so maybe 5 years down the line, will they be running the same kind of business model that they are, or how do we see a change there?
So there are two elements to it. I think the worst in terms of the regulatory pressures are behind them. Okay, and you've got a new environment that's set up as these companies go in for high-speed broadband. I think you put it together, one will create incremental amount of cash flow, and the other one will hopefully put a business up, long-term business up in play, which is very profitable.
It includes power mesh and those.
That's an engineering business.
Engineering business. Okay, fair enough. I just want to, before we let you go, you're looking at the SME space very closely as well. You've got over 10% holding in.
It's a much smaller part of it, yeah.
Yeah, in two SME companies, right?
Yes.
One is called Mac Power.
Yes.
The other is.
Yes.
Yeah. So can you just talk about what the rationale there is, and what do you see there?
So we found two interesting trends play out in that in companies getting listed there. I think one significant one is when we went into demonetization and GST last year, we talked about a lot of individuals talked about the unorganized to organized trade that was taking place. We see something different as far as companies listing on the SMEs exchange is concerned. We're seeing the larger of the unorganized companies actually coming into the formal system. So the unorganized participants are actually getting formalized, and they're coming into the firm. For this, they need a balance sheet. Okay, and while these promoters have been around and the businesses have been around for an extremely long period of time, they don't have a balance sheet to access formal capital, and that formal capital doesn't allow them to grow. Okay, I think that's predominantly a number of companies that we come across in that space. So it's an interesting opportunity. There is a valuation arbitrage, but there's a huge liquidity risk that also goes with it.
So, I mean, as a percentage of your portfolio, is very small. It's about.
It's tiny, but you will see us do more.
But you want it growing.
You'll see us doing more out there.
In the SME space, Kenneth, it's a pleasure. Thank you very much for coming in. Completely out of time, so thank you again.
Thank you very much
for being here on the show. Kenneth Andrade with Old Bridge Capital, talking about his thoughts on the market and what he's doing across sectors. We take a very quick break here. Up next, we focus back on the market, which is, cruising along. Still 65-70 points, 10,674. So no change actually from when we started at 11.
Well, a lot of action in the mid-caps today, you'd have to say. So Just Dial is up around 14% and in fact, it's gained 30% on a month-to-date basis. And a couple of other stocks include SpiceJet up 13%, Reliance Naval and Engineering, Relcom, both from the Anil Ambani group, both those stocks up around 10% and Spark, which is Sun Pharma's R&D arm, has been enthused by Sun Pharma's numbers as well. So that stock is up around 8.5%. So very colorful market when it comes to a lot of these select mid-caps, and the mid-cap index itself is up around 1.2%. Well, on that note, we're going to wrap up this edition of Trading Hour.